The ECB just warned at the Sintra Conference that AI investment is dangerously concentrated. Most retail portfolios are blindly exposed to a bubble they cannot even see. I built a private local system to track these systemic risks without handing my net worth to a third-party app. I was sitting in a private aviation lounge at Teterboro when I first read the report from the Sintra Forum. The language was clinical, but the meaning was terrifying. They were talking about non-linear correlated losses. That is central banker speak for a crash where everything you own drops at the same time because it is all tied to the same few companies. I looked at my own setup and felt a pit in my stomach. I had been using 3 different autonomous finance apps to optimize my taxes and rebalance my portfolio. I realized I was handing over my full brokerage API keys to startups that are themselves heavily exposed to the AI bubble. It is a privacy honeypot. These companies are essentially vacuuming up the net worth data of the world's most successful professionals, while relying on the same unstable infrastructure they are supposed to be monitoring. That is when the reality hit me. The European Central Bank Financial Stability Review specifically highlighted concentrated exposures to AI-related investments. Most people are just riding the trend. They think they are diversified because they own an index fund. But that index is now a concentrated bet on 5 companies. I decided I could not trust a black box with my financial survival. I tried to fix this by using generic LLMs. I spent a weekend feeding macro data into ChatGPT and Claude to see if I could quantify my risk. The results were useless. They gave me buy and hold platitudes. They told me to diversify into bonds and maintain a long-term perspective. I did not want a pep talk. I wanted a risk model. I wanted to know if my portfolio was mirroring the leverage patterns Tobias Adrian from the IMF warned about. He specifically pointed out the rising leverage by both the borrowers and the investors in the AI space. That is a classic sign of a bubble. When the people borrowing the money and the people lending it are both using leverage to bet on the same asset. The correction is usually violent. I was walking through a penthouse open house in the financial district, looking at the floor-to-ceiling glass. And I realized that the people buying these places are often the most exposed. They are using the gains from an AI surge to buy real estate, creating a cross-asset contagion. I needed a way to see these connections without my data leaving my own hardware. I needed to stop being a user and start being an architect. The first move was simple. I stopped using cloud-based models for my sensitive data. I installed Llama on my local machine and ran Llama 3. For those who do not know, Llama lets you run massive language models directly on your own GPU. It means the model lives on my hard drive. It does not call home. It does not train on my balance sheets. I remember the visceral relief when I ran the command, Llama run Llama 3, and saw the prompt appear in my terminal. I fed it my full portfolio export. I asked it to identify the percentage of my holdings that were indirectly exposed to the non-EU AI model providers. The ECB supervisory speech recently warned about this exact dependence. My system told me that, while I thought I was 20% exposed, I was actually 42% exposed when you account for the supply chain. That number stopped me. It was the first time I had a real answer instead of a generic suggestion. Because the model was local, I could be as specific as I wanted. I could upload my private equity statements and my crypto wallets without worrying about a data leak at some VC-funded startup. My net worth data never touched a third-party server. That is the only way to maintain true financial sovereignty in 2026. Running a local model is great for privacy, but a local model is a closed loop. It does not know what happened 10 minutes ago at the IMF. To fix this, I built a live data layer using the Perplexity API. Perplexity is different from a standard LLM because it is a search engine with a reasoning layer. It can browse the live web and return source citations. I wrote a Python script that triggers every 4 hours. It uses the Perplexity API to scan for specific keywords like systemic risk, AI leverage, and ECB stability updates. It does not send my portfolio data to Perplexity. Instead, it asks the API to summarize the current macro sentiment regarding I concentration and returns a structured JSON file to my local machine. Then, my local Llama 3 model takes that live summary and compares it against my private holdings. I set up a specific prompt that tells the model to look for discrepancies between market sentiment and institutional warnings. For example, when the IMF released a note on the structural nature of AI cybersecurity investment, my system flagged it. It told me that my cybersecurity holdings were not just a hedge, but were actually becoming correlated with the AI bubble itself. I was able to trim 3 positions before the rest of the retail market even read the headline. The final layer was the Wealth Command Center. I did not want to stare at a terminal all day. I used Streamlit, which is a Python framework for building fast data dashboards. To create a private interface, I connected my brokerage APIs via a secure local proxy so the keys never leave my environment. I built a custom metric I call the non-linear correlation trigger. This dashboard monitors the delta between the price of AI semiconductor stocks and the credit spreads of the companies borrowing to build the data centers. When those two numbers diverge too far, the dashboard turns bright red. It is a signal that the leverage Tobias Adrian warned about is reaching a breaking point. I was at a Michelin-starred restaurant in London last month when I got a notification on my phone. My local server had flagged a spike in AI model provider dependence in the EU market. I did not have to guess if it mattered. I opened my dashboard and saw that my exposure to non-EU providers had crossed the 30% threshold. I executed 2 hedges in under 2 minutes, while other investors were reading a newsletter about it the next morning. I had already locked in my gains. This is not about trading. This is about building a system that manages the tools. You actually trust a VC-funded startup with your entire financial life just to get a few AI insights? If the answer is no, you need to move your intelligence layer offline. Subscribe to WealthUs if you are tired of the black box and want to build real financial infrastructure. I leaned back in my chair today, looking at the local system running in the background of my office. I realized that the biggest risk in 2026 is not the AI bubble itself. The risk is the circular dependency. If you use a third-party AI to monitor AI risk, you are blind to the systemic collapse of the provider. I shifted from being a passive consumer of AI apps to becoming the architect of my own wealth. I stopped asking which tool I should use and started building the system that manages the tools. I have my own personal Bloomberg terminal now. It does not sell my data. It does not give me generic advice. And it does not sleep. It just monitors the numbers. I have gone from a feeling of blind anxiety to a state of technical autonomy. I know exactly where my risks are because I own the model that finds them. That is the only way to survive a concentrated market. I am sharing the exact configuration and the Python architecture I used for the command center in the description below because the window to hedge against this concentration is closing fast. Stop trusting the black box and start building your own. I will see you in the next video, where I show you how to use local AI to automate your private equity due diligence.